day-to-day trading challenges. First of all, losses are a part of the game. So sometimes losing streaks might be inevitable. So even though it's inevitable, how you handle them can significantly impact your long-term success. I had one student, he would be on a losing streak and he would increase his position size. Every single loss he would take, he would just increase his sizes. Well, that doesn't necessarily make sense to me. So first of all, instead, if you're on a losing streak and like maybe you've been on a losing streak for a while, reduce your position size so that it can minimize your further losses. And it'll also help you maintain a clear mind and easily stick to your trading plan so you don't let emotions drive your decisions. Like, let's say, knock on wood, but let's say in July, I took 30 losing trades in a row. 30. Well, I would lose a lot of money if I did that. Maybe like at least like $10,000 probably. So, if something all of a sudden wasn't working and I was on a losing streak, first of all, I could just accept that, analyze what went wrong, and move on. But also, I could size down and try to reframe. Maybe, like, for example, I used to trade with like 10 to 20 contracts. And whenever I moved up to 25 contracts and 30 contracts, for some reason, all those trades were just shitty. And then I went back to 20 contracts and then all my trades were great. And the reason why I could have been taking like shittier trades or taking more losses or hesitating more or just like cutting off a trade and not letting it play out, it could have been because of my position size. So sizing down could definitely help. Also, that's drawdown. So a drawdown is like essentially whenever you like kind of deplete your account. So let's say you start off with a $10 account and you're $2,000 in drawdown. You'd have an $8,000 account. So to handle drawdown, the most important thing is reviewing. You need to figure out what's the cause of your drawdown. Like, is it market conditions? Is it a flaw in your strategy? Is it emotional issues? If you're not journaling, you won't be able to see what's the root cause of the drawdown. So that's really important. You need to address the root cause. Also, during a drawdown, like I said, reduce your position size, manage your risk better, and this will help you regain your confidence. And emotionally, it can be a little bit hard to experience a drawdown. So even though it will emotionally challenge you, you need to continue sticking to your routine and show up every day. Because if you stop in a drawdown, how are you going to ever get out of that drawdown? Maybe that could have been like that one scenario I was telling you. 30 losing trades in a row, but boom, after all of those, you have 60 winning trades in a row after that. That's because the market's random. And the series of wins and losses will also come randomly. So if you feel weighed down by losses, know that you could lose more trades than you win, and you could still emerge a successful trader. It's all about how you frame your losses and the actions you take to learn from them. So a trader with a 30% win rate could literally outperform a trader with an 80% win rate if their gains on winning trades far exceed their losses in the losing ones. So it's all about quality, not quantity of wins. That truly matters. So like, for example, I know one strategy for option selling. Like I tried to do a little bit of option selling. Well, I stopped doing that because I'm going to tell you, it had a 90% win rate. But in the winning trades, you would win $100, and then in the losing trades, you lose $7,000. And unfortunately for me, the first option selling trade that I took, I lost $7,000. So after that, I stopped selling options. But that's just not an effective strategy. Even though it won 90% of the time, those losses outweighed those wins. So a trader in my program who has a 30% win rate and maybe slightly above a 1-to-3 risk-reward ratio could have literally been more profitable than the other strategy that has a 90% win rate. So, it's just all about accepting that. And, what you just need to focus on is, did you follow your plan? Why did you enter or exit the trade? Was your exit strategy effective? What could have you done differently? Learn from your losses. Let it go and move forward. So clinging to past losses can paralyze your decision-making. And it was like that one example I told you before. You take a loss today, you don't trade tomorrow. That would have been a winning trade. You trade the next day, you take a loss. And then the next day, you don't trade for 4 days. And those 4 days would have been a 4-day winning streak. You cannot let those losses paralyze you because it literally could lose you money. So, a lot of traders have an issue like fear, anxiety, fear of losing money, a fear of making wrong decisions. This could also paralyze traders. So also like with FOMO, like the fear of missing out. And all of that could lead to either not taking trades or taking impulsive trades. It will either lead to significant losses or making you miss out on gains. So I do have the other lesson that we did a month ago about those exact fears. I recommend to watch it. And then, another issue is like overconfidence and greed. I feel like a lot of my students have that issue. And it is really important to, instead of being greedy, the easiest fix, have a plan, place limit orders. 1 to 3 risk reward ratio. How are you going to be greedy if you have a plan and you follow it and you're disciplined? So, have a stop loss, have a take profit, 1 to 3 risk reward ratio. Boom. If you're overconfident on a trade as well, like some people might want to gamble 5K for the possibility to make it into 300K. And it sounds great, but how realistic is that really? Do you have a proven edge with that? So it's also having realistic goals. Have achievable, realistic goals and trust in your analysis. Also, like I would, if we're talking about goals, someone's goal might be making $1,000 per month. I would frame your goals not necessarily on the output. Like making $1,000 a month is an output. That is the effect, but that's not the cause. So I would advise your goals to be input based. So how could you make $1,000 per month? Okay, take 1 trade a day with a 1 to 3 risk reward ratio. Try to increase your win rate. Only take high quality trades. Those are goals that are closer and more achievable. And then the money will be a byproduct of following those goals. So that's what I recommend. And I have a bullet point here about revenge trading. I think to avoid revenge trading, just follow a plan. I think at the end of the day, the moral of the story is just having a strategy, being consistent, following your plan, having everything meticulously defined. That's it. And, I'm just going to keep rambling on because I created so many slides. But if you guys have any questions, you can type it in the Zoom chat. And from there, I think there's also other psychological challenges that are harder to fix other than those other ones. It's simple. Have a rule, follow your plan, 1 to 3 risk reward ratio. That's literally all you have to do to fix those other issues. But here, these ones are a little bit harder. So like selective hearing. And so for example, traders, sometimes they only hear what they want to hear and they're influenced by their own biases. And this selective hearing or even like selective seeing, like only looking for confirmation, but not looking at red flags, for example. This can lead to taking bad trades and losing money. And then, cognitive bias. That's like basically, or even like confirmation bias. Like if you're looking for confirmation and then you see your confirmation that you usually see, but you avoid the red flags, this could also cloud your judgment and lead to poor trading decisions. So actually, there was a day recently where I didn't take a trade for a laid out set of reasons. And I was chatting with one of my students about that specific trade. I told them, hey, this is exactly why I'm not taking the trade. But based on selective seeing, selective technical analysis, selective confirmation looking for, I didn't take the trade, but they took the trade because they only kind of wanted to see what they wanted to see. And I think that was, so for example here, I don't have the chart that goes with it, but these were all the reasons why I didn't go short Apple supplies on the 25th. So first of all, I realized that there was a bull flag on the higher time frame. So it looked bullish to me on the higher time frame. Also, price was pretty much above the 9 EMA most of the day. Price was above the open price most of the day. There was consistently higher lows. Even though there wasn't higher highs, it was higher lows and there was super low volume. So I didn't see Apple's price descending from that supply zone versus immediately when it went below the 9 EMA and then it was below the supply zone. It went below the 9 EMA and went below the supply zone. I don't know if there was another confirmation that my student had. They just took the trade. Avoid not even selectively only seeing their confirmations that they usually see, but also having a bias and not seeing the red flags that were there. And I literally gave them this list and they still took the losing trade. Maybe it could have been valid. Maybe it was just following the plan. But also it's important to be a little bit adaptable in trading and not allow your cognitive bias to affect your decision making. So there's a couple types of biases, but how we manage these biases is important. So we should be aware of the factors that can bias us. Oh, we see a supply zone, but price has been super bullish all day. We're in an uptrend. There's a bull flag. We're above the open price. We had really strong buying volume, but we're coming into a supply zone and we slightly went below the 9 EMA. Those are the two things that could have caused a bias in your brain versus looking objectively and there was red flags all along, but you were biased, so you didn't see them. Also, we could talk about self-esteem. This is like what I was talking about a little bit before. If you're like a depressed person who has negative self-talk, that will directly reflect in your trading. So a trader's self-esteem significantly impacts their trading performance. Like even if you have high self-esteem and nothing could break you down and you're super confident, maybe you'd be overconfident in your trades and think, hold a trade and 50%, 60%, 70% drawdown. No, I'm confident this trade is gonna move my favor. It could work against you either way, your self-esteem, but also low self-esteem. It could cause hesitation, doubt, negative self-talk, not taking trades when you should be. So either way, we need to have a calm mind, not be overconfident or have low self-esteem either. And then from there, I want to talk a little bit more about like being a trader. Traders often tie their identity to their trading outcomes. And this is really common in the trading space, especially for like people on social media, like all of you guys. You guys found me on social media. My trading profile on Instagram, it directly ties my identity literally to my trading outcomes. And this could also be a mistake because sometimes a losing streak can thus affect our self-worth, and that could lead to a negative feedback loop. So we really want to separate our identity from our trading results. And it's really, really important to maintain emotional stability. So yeah, and then I did want to say a little bit more about biases. So like a lot of people enter a trade just because they think they know where the market's going to move. But it's really important to understand that your thoughts have zero influence on the market. You cannot predict what's going to happen next, and your thinking is not going to influence the market direction. Therefore, before entering any trade, you need to have confirmation and a valid thesis for your trade based on multiple factors. This is very vital, and a lot of people ignore it because they let their ego and their bias get in the way, and they just enter in trades for no good reason. So successful trading, you should understand and just follow the market instead of trying to make your own predictions and biases. Like, for example, I was talking to this one guy on Discord whenever I was like doing all that Discord stuff a few months ago, and this guy, he just felt so strongly that the market would tank because we were at all-time highs. And every single day, he would take puts and then lose it every day. And then he was doing this for like a month. And then he like lost $100,000. Or like maybe he was doing a little longer than a month. He lost $100,000 and then he's like venting to me on Discord. Like whenever I was in that Discord group, it was that guy in the Discord groups. Just a random guy in there. And I was telling him all along, like, dude, there's no signs. Nothing in the market is telling us that the market's going to go down. Nothing. We're still seeing higher highs. We're still seeing higher lows. We're still extremely bullish. We have strong sentiment. There's strong news coming out every day. The market's in an uptrend. AI is booming. This could be another AI bubble, but the bubble hasn't popped yet. And there's no signs of selling pressure. So this is where I created the lesson. It's actually in the inner circle. And it's called Why Not to Call the Top. And it's really important to not let your bias of like, oh, we've been uptrending, so it must come down. Well, sometimes it won't come down for a long time. So like, I think I created this lesson for the guy, or maybe I had it already, but basically it's like, if the market's bullish, don't be the first person to take a short. If the market's still rising, avoid premature short positions and just wait for something actual genuine in the market that will give us a sign of a reversal. So, like for example, NVIDIA, I think would be a great example. NVIDIA has been really strong and it's been uptrending. And if you have a bias, oh, NVIDIA has been uptrending for way too long and needs to go down. This little pattern here it's not exactly confirmed yet. It could not even be a head and shoulders pattern because price has not gone below this level. So if you have that bias, you could prematurely take a short position when there's really no signs of selling pressure yet. We literally just hit a new all-time high. We're still in higher highs and higher lows. So, if we break above this supply zone, we're still bullish. Nothing's going to happen that's going to be short. So like, don't take those leave puts yet. Wait for confirmation. So that's very important to understand. Not selectively processing information that only supports our views. So that's really important. And also, I kind of wanted to talk about like withdrawing. My student Steve actually, he started doing this more often and he's been seeing more consistent gains and growth. Also, my student Circan, he started off with $1,000 account, and every single week he was withdrawing his profits. And from there, every week he was 50% in his account, 50%, 80%, 100%, 50% on a weekly basis. So withdrawing allowed both of them to actually keep their gains. And instead of like you don't need to be the person who flips a $500 account to $500,000 and never withdraw. So avoid that trap. Many traders fall into the trap of like trying to keep all their profits in their trading account, trying to like compound their gains continuously. And it kind of makes sense. Like the approach seems logical, but it exposes you to a lot more risk. So I would recommend regular withdrawals until you're ready to size up. So like, for example, if you start off with $1,000 account, you're not ready to size up to 2 contracts, keep withdrawing those, withdraw until you're ready to size up with 2 contracts. And maybe there's just like 1 week where you could keep those profits in there, do 2 contracts from now on. And then, maybe you grew your account from 11 or 1,000 to 1,500. 1,500 is enough to trade with 2 contracts. From there, withdraw anything above that amount. For me, my trading account, I only keep in there what I trade with, like on a weekly or like bi-weekly basis, because the money always settles anyway. So I always take out my money. It's very important to realize your gain. If you take withdrawals, it turns like your random digital profits in your trading account that still has risk, and it makes into real money. So having a psychological shift of like actually taking your gains, this can help reinforce positive trading behaviors and avoid like errors. Like, for example, I've seen people like on Robinhood, like Wall Street Bets, grow their account to like 100K, and then they keep all the money in there, and then one day they start sizing up really heavy, and then all of a sudden they lose every single dollar they ever made with trading, and they never got to take any of it for themselves. And maybe they lost even more than what they started off with. So it's very important to just have a routine for withdrawing profits. It could be weekly, daily, monthly, just having some regularity. And this also helps you with your discipline. So, also just reduces the amount of capital at risk, because whatever capital you have in your trading account, it is at risk. All of it's at risk. So just keep a consistent amount in your account. And if you have profit above that amount, withdraw it. That's what I do. All right. Now I want to talk more about position sizing. Earn your position size. I think this is really crucial, and this is exactly what my position sizing strategy is all about. Start with your smaller account balance and increase it only as you demonstrate profitability and risk management. So, like, if we're talking about position size, what does that mean? It's a little bit different than account size. Position size refers to like the actual amount you allocate per trade. So like, for example, I have a 50K account. Usually I'm using 5 to 8K per trade. That's a consistent position size. That's my consistent account size. So your position size dictates how much you're willing to risk on a single trade. So how I recommend my students to size their positions. First of all, if you're a complete beginner or if you're unprofitable, restart. If you're a complete beginner, trade with 1 option contract for your first month, or you could do 2. It depends. There's some people who feel like 1's not enough, and that might be valid if you have a strategy for like trimming contracts. That would make sense to me. So like, for example, one of my students will start off with 2 contracts because they want to follow the 9 EMA exit strategy, exit 1 contract at the 9 EMA, and then let the other one either hit stop loss or take profit. And that's valid. So you could do 1 or 2 your first month. But you want to prove to yourself that you could become consistent at trading before you put extra money on the line. So ensure you are profitable for at least 1 full month straight with good risk reward, and your average win, not just a random number in your brain, a real number, should be at least double or 3 times than your average loss. Then you could size up after that. So that's your first month. Then your second month, if you met that criteria, then you could trade with 2 contracts or 3 contracts in your second month. Experiment with trimming positions or trying some other exit strategies. And don't randomly switch between the number. If the first month you're doing one contract, the second month you're doing two contracts. That's it for the entire month, only two. Don't randomly switch between that number. It's very important for consistent position sizing, because especially at the small scale, when you go from one contract to two contracts, that's double. That's double. So like that's literally me right now. If I was going for 5K per trade, automatically going to 10K per trade. That doubles my risk, and that exposes me to more risk, and that gives me a higher probability to lose the profits that I made in the previous month. So you want to make sure, especially at that lower scale, that's literally double. So you want to be consistent for every single trade so you don't open yourself up to those risks. And then each of the subsequent months after that, incrementally scale up. You know, it could be each month, it could be each quarter. Only if you continue to meet the criteria. You have to be profitable. You have to make sure your average win is at least double or 3 times more than your average loss. For me, like technically, if I was following these rules, I could size up every single month. It's just like I don't want to, and that's fine if you don't want to. So do something you're comfortable with, and you know, incremental sizing rather than one day choosing 2, the next day choosing 5, the next day choosing 7, the next day choosing 1. The incremental sizing will not only make sure you're profitable for the month, like before you start managing higher positions, like you got to make sure you could manage smaller positions, but also in the long run, it's going to allow you to keep more of your profits, even if you take losses. And scaling too quickly increases your risk without sufficient profit to cover it. So for example, if I took one winning trade today, and that was a winning trade with one contract, and I made, let's just say $100. And then tomorrow I double it, and like, you know, we're risking $30 to make $100 with one contract. Now I'm trading with two contracts, risking $60 to make 200 bucks or something like that. Not exactly, like $60 to make like 180. And then let's say with the two contracts, I lose, but I size up again anyway, because I think, hey, I'm going to make back all my losses if I size up again. So the first trade, $100 profit. The second trade, $60 loss. Now I size up to 5 contracts. So now I'm trying to risk, like, let's just say the risk would be more like $100 to make $300, let's just say. And, you know, right now I'm at like $40 net profit. I trade with 5 contracts now, and I lose that next trade again. And now I'm overall negative out of these 3 trades because I'm just randomly sizing up my positions. So now that I'm overall negative, I'm going to try to size down. Now I go to one contract. Oh, now I have a winning trade. Well, that winning trade didn't cover the losses. And this is going to keep you in a trap of unprofitability and not being able to realize your gains. So anyone can make money in trading, but the hardest challenge is keeping that money. So it's not real profit until it's safe in your bank, not just sitting in your trading account. So secure your profits with regular withdrawals, make it a habit, and keep that money where it belongs, with you.